There was once a time, not that long ago, when the size of the national debt dominated political conversation. In 1992, when Ross Perot ran for president on that issue alone, the debt was about $4 trillion.
Currently, the U.S. national debt stands at a staggering $34.8 trillion. To put that in perspective, with the U.S. population around 333 million, that's over $100,000 in debt per person. While the sheer number is concerning, it's the trend that's truly alarming. As my friend Richard from the Plain Bagel once said, you don't need to be an economist to see
recognize that this is a pretty alarming chart. And it's why some have gone so far as to claim that the US, with its insatiable spending, is headed towards a debt crisis.
The most worrisome aspect is that the US government can't repay this debt. The Congressional Budget Office has projected that in 10 years, the situation will be even worse. So, where does this lead? And is there a way out of this debt trap? Let's break it down. The government is $34.8 trillion in debt and adds more each year. But how does this process work? Much like individuals, a country goes into debt when it wants to purchase more than it can afford. Countries have income and expenses, and when expenses exceed income, they borrow money to cover the difference. This borrowed money must be repaid, and if the country can't pay it back, it defaults, similar to a homeowner defaulting on a mortgage. Here's how it works. When the government needs more money, it sells government bonds. Investors lend money to the U.S. Treasury, and in return, the Treasury promises to pay them back with interest at a future date. The interest rate depends on the bond's maturity date. For instance, the current 10-year U.S. Treasury yield is about 4.3% annually. It's not just individuals who buy these bonds. Businesses and foreign countries do too. Countries like Japan, China, and the UK hold substantial amounts of U.S. government bonds. A U.S. default would have global repercussions. Additionally, the U.S. Federal Reserve, the nation's central bank, can also purchase treasury bonds. This process allows the Fed to print money, injecting it into the economy by buying government bonds. Understanding this, we can look at the U.S. deficit. The main reason for a country's YP is spending more than it earns, known as a deficit. A worse annual deficit means the government needs to raise more debt each year. For example, if the government spends $4 trillion but only generates $3 trillion, it needs to sell $1 trillion in bonds. Examining U.S. surplus and deficit trends reveals that the last surplus was in 2001, with a $130 billion surplus. Since then, deficits have grown, and despite excluding the significant deficit years of 2020 and 2021, the gap between spending and income continues to widen. This trend necessitates selling more bonds each year, deepening the debt. In 2001, the national debt was around $10 trillion. Over 23 years, this has ballooned to $34.8 trillion. The issue is that the U.S. can't pay down this debt, and perhaps it doesn't want to. Here's a breakdown of the current budget. This fiscal year, the U.S. has generated $3.29 trillion in revenue, but spent $4.5 trillion, resulting in a $1.2 trillion deficit. Revenue mainly comes from taxes, 51.7% from individual income taxes, 34.2% from Social Security and Medicare taxes, and 9.4% from corporate taxes. Expenses include 21% on Social Security, 14% on Medicare, 13.3% on interest payments for debt, 13.3% on health, and 13.3% on defense. To address the deficit, the U.S. needs to either increase revenue, decrease spending, or both, none of which are popular options. Higher taxes or cuts to essential services are undesirable. If left unaddressed, the problem will worsen. The Congressional Budget Office predicts the deficit will grow from $2 trillion in 2024 to $2.8 trillion in 2034, increasing the debt-to-GDP ratio from 99% to 122%, surpassing the previous high of 106%. The U.S. is in a tough spot. Budget cuts are unpopular, and raising taxes isn't either. Complicating matters, the U.S. faces higher interest rates, a challenge not seen in over 2 decades. The Federal Reserve, separate from the government, sets interest rates to maintain economic stability. Recently, due to inflation, the Fed has raised rates from 0 to around 5.5%. Higher interest rates affect government debt. When debts mature, the U.S. must roll them over by selling new bonds. Previously, these were at low rates, but now they are higher, increasing annual interest payments and worsening the deficit. This fiscal year, interest has been the third largest expense category, with $601 billion spent on interest payments since October 2023. The Congressional Budget Office reports that interest costs will rise, expecting them to be higher relative to GDP than at any point since 1940, reaching 4.1% of GDP by 2034, or 1/6 of federal spending. Mandatory costs rising means less discretionary spending, leading to tougher times, higher taxes, or more debt to cover interest payments, a debt spiral. Reducing the deficit and returning to a surplus is the best option, but this seems nearly impossible. An alternative approach is inflating away the debt. Let's go back to 1970. The median house price was $24,000, the average annual salary was $9,170, and a loaf of bread cost $0.24. Taking out a $24,000 mortgage then would seem cheap now due to inflation, which raises wages and prices over time. Applying this to government debt, inflating away the debt means letting inflation reduce the value of currency, making future debt repayments cheaper. After World War II, the U.S. used inflation to lower its debt-to-GDP ratio. Today, the Federal Reserve could print money, buy government bonds, and use the money to invest in job creation and infrastructure, boosting productivity and GDP. Increased GDP and steady inflation over time make past debts smaller in comparison. However, unchecked inflation leads to economic instability, social unrest, and currency devaluation. The Federal Reserve targets a 2% inflation rate to keep the economy growing and gradually devalue debt. The most sustainable approach to managing debt is smart fiscal policy, focusing on productivity and reducing the deficit. Australia's recent budget surplus of $22.1 billion shows the benefits of exceeding income over expenses, allowing for investment and debt reduction. In conclusion, the U.S. faces significant debt challenges, but the focus should be on productivity and fiscal responsibility. While there are strategies to manage debt, long-term solutions involve balancing the budget and ensuring economic stability. Thank you for watching. If you enjoyed this video, please like and subscribe. Also, your opinions on this matter are more than welcome, so let me hear what you think. See you in the next video.